Welcome everyone to Solve Advisor's webinar on trends and challenges in fixed income valuations. This webinar is being recorded and will be sent out to all registrants after today's session concludes. The opinions expressed in this webinar are those of the individuals and do not represent opinions of the companies they represent. At the conclusion of our session, we will open it up to questions from the audience. To submit a question, simply put it in the Q&A portion of this webinar platform. For questions we do not get to, we will follow up with responses from the appropriate panelists. I'm now pleased to introduce our host, co-founder and CEO of Solve Advisors, Eugene Grinberg.
Thanks a lot, John. I'm Eugene Grinberg, and I'm pleased to be joined today by two experts on fixed income valuations. First, we have Rajan Chari, who's a partner at Deloitte. Rajan has served a wide variety of Deloitte's investment management clients, including mutual funds, private equity funds, family offices, and investment advisors. In addition to providing audit and other services to his clients, Rajan currently serves as a professional practice director for the U.S. investment management industry group. In this role, Rajan is responsible for providing accounting and auditing consultation to the audit practice in the U.S., for performing certain risk management activities, and for representing Deloitte and industry task forces and committees. Rajan also serves as a co-author of Deloitte's annual fair value surveys for investment companies. Our second panelist is Piers Lohr, Director of Product Development with ICE Data Services. Piers Lohr is Director of Product Development at ICE Data Services, a leading provider of market data solutions, which is part of the Intercontinental Exchange. Piers is responsible for product development and portfolio analytics, pricing, curves, and other fixed income solutions. Prior to joining ICE in 2019, Piers was a business manager at Bloomberg, responsible for evaluating pricing and curves across municipal, corporate, and government bonds globally. Before joining Bloomberg in 2010, Piers was founder and portfolio manager of Lohr Capital Management, a registered investment advisor. Rajan and Piers, welcome to our webinar. So before turning to my co-panelists, I just wanted to say a couple of words about Solve and give a little bit of an update on our products, specifically from the point of view of middle and back office. So firms, particularly on the buy side and the sell side, get a lot of valuable market data through the front office. So traders, portfolio managers are typically seeing many thousands of messages through their Bloombergs, through their corporate email, through chats, and so on. So there's a lot of valuable data that's actually available, but it doesn't always make it. It doesn't always propagate throughout the firm, particularly middle and back office. And part of the reason is because it's difficult to capture. So a key product that we've offered for quite some time is the ability to capture this data through parsing messages and unstructured content. That's one of our key data offerings, is giving firms the ability to capture pricing that they're receiving, but it's difficult to sort of translate it into something that's digital, something that could be searched and visualized and shared with the rest of the firm. A lot of this pricing has to do with the bids and offers and two-way markets that are being shared by the broker-dealers, bid lists, market commentary, general market call, you name it. So that's sort of the parsing piece that's key to our offering. The second is the observable market data, which goes side by side with information that we could capture for our clients. So we have many dozens of clients who share their data with us, both on the buy side and the sell side. So that data looks very similar to what firms are receiving directly, but the combination of what's captured for an individual firm and what's also crowdsourced from the rest of the market goes a long way to creating price transparency. The third piece that we offer is composite pricing. So we think of the composite price as essentially a market consensus price. So it's a smart composite of the individual bids and offers that we're seeing in the market, and trying to boil down based on proprietary logic to some sort of a consensus bid and consensus offer price. So that's a third piece of the puzzle that you would think of as pre-trade pricing. So parsing, observable market data, and composite pricing is what we think of as pre-trade. The next piece is the post-trade piece, which is trace. So the combination of pre-trade pricing and post-trade gives you a very solid picture, a full picture of what's active in fixed income markets. And then the last piece of the puzzle is the critical workflow tools that come side by side with these data products. These allow identifying matchers between what's actionable in the market through BWICs and dealer inventories, two-way markets, and what a particular client sort of cares about. And there's some additional workflows that are specifically targeted for the middle and back office as well. In terms of product coverage, on a high level, we're in 5 asset classes and cover about 500,000 individual securities in those 5 asset classes. So we have global coverage in securitized products, which obviously is all the variations of asset-backed securities, mortgages, commercial real estate, CLOs, and so on. It's corporate bonds, which again, all the variations of IG, high yield, EM, and so on, syndicated bank loans, single name CDS, and municipal bonds. This is sort of a quick summary of some of the benefits for the middle and back office. There's a little snip of a product, self quotes, where you're seeing the different data sets side by side that give you sort of really strong transparency on a particular security. So the data points that would have come from your firm's messages, where we actually mask the provider. So those would say if you receive the market from JP Morgan or Credit Suisse, so those would be attributed to the dealer that sent you that color. Anything that's anonymized that looks like self tier 1, tier 2, tier 3, that's representative of the data that we source from the larger market that we anonymize and we tier. So tier 1s would be the primaries. Tier 2s would be sort of large regionals with balance sheets, and tier 3s are smaller bond crossing shops. The green data points are the composites, and similarly you see it on the chart as a sort of a range of the market consensus bid and offer, and then the blue is trace, right? So between these 4 components, you get that full picture of fixed income markets. And just to summarize the benefits for middle and back office, you're able to access the same data that the front office is seeing on a daily basis. So by digitizing it and centralizing it and allowing it to propagate throughout the firm, you get access to the same data. What's critical for operational excellency is the ability to achieve independence, not rely on the front office kind of sharing things and potentially cherry picking things. Same data could also be made available to your third-party administrator. And given kind of this variety of data sets, you're able to increase price transparency. So that was just a quick intro. At this point, I'm happy to turn to my panelists. And my first topic I'd like to direct to Rajan. If you're a producer of fair value pricing, why is it critical to incorporate observable data into your process?
Great. Thanks, Eugene. Hi, everyone. Glad to be with you. You know, that your question's a good one, and it's a sort of a basic fundamental I'm of course an accountant by background, not going to be apologetic for admitting that I'm an accountant, but I always first look at the accounting literature. And if you're somebody that needs to follow generally accepted accounting principles in the United States, you essentially have to incorporate observable data into your pricing. The accounting standards codified in US GAAP ASC 820 is the codification standard, really deems them to be more reliable than unobservable inputs. In fact, if you look at it, first you have to, if you have an actually a price, you call it exchange traded price, identical asset, that's the price you use. But then you go through a hierarchy and you are required to use a methodology that maximizes the use of observable data and minimizes the use of unobservable data. So you are essentially required to do that under GAAP. It's not only that GAAP requires it, but also the regulator, the Securities and Exchange Commission. If you think back to maybe almost 2 years ago now, June of 2019, there was an administrative proceeding against an investment advisor, hedge fund manager, and essentially the SEC made exactly the same comment about that entity choosing a methodology that failed to use observable inputs. In fact, saying, let me quote it here, the traders developed an approach to valuation that in certain instances failed to ensure that observable inputs were maximized. So again, if you have the choice of using, let's say, your own methodology, or say a single broker quote that may not have any support behind it, or using sort of observable market data, you're essentially compelled, at least under the standards, to use observable data.
That's great. Piers, did you want to comment on that as well?
Yeah, I think this is actually neat. Thanks for having me on here. I think it's actually great between Rajan and myself, coming from a slightly different angles, in that there's the accounting and some of the regulation angle. There's also, which is something we care about in the valuations business, of course, but also the practical angle, which is in terms of evaluated pricing service at ICE, our clients need to follow regulations and accounting and things like that. But frankly, also have a fiduciary duty to their investors, those coming in and those going out. And that means their assets need to be priced as accurately as possible. So for us, accuracy is key. So to not use observable data, that's good data, is strange and probably is going to lead to less accuracy. So I just think it's neat to hear kind of both sides of that coin.
Excellent. Piers, so how can firms ensure that the market data that they're using is accurate and timely?
Yeah, so this is tough, particularly in fixed income. There's a lot of different data that is available. I like to think about it in terms of different dimensions. So the first is the timeliness of that data. So in a very slow market, data that is a few hours old might be absolutely appropriate and fine, and it might be the best thing you have, which is fine. In a fast moving market, that may not be the case. But other than the timeliness, really being able to test your sources in a couple different ways, one versus executions themselves. At ICE, we have a data scientist team. We also have a quant team, and they work hand in hand to actually analyze different market data sources over time and in current status to make sure the data we're using is frankly the most accurate you can get. And what do those tests kind of look like? Versus executions, it's really kind of an after the fact analysis, whereby you look at all the bids and offers and things like that from a market data source, compare them to the trades that actually happen. In some asset classes, that's harder because corporates, we have visible trades to see, and other areas we don't. So it becomes a little tricky, but always analyzing versus executions is key. And as a second best, but also very valuable, is comparing the sources to each other. If you have two sources that are contributing on an overlapping set of bonds, as long as it's statistically significant, a few hundred bonds, you can actually do a time series of those two sources and see if one of them has a lead lag profile, right? If one of them statistically, just a quant and a little bit of work, can figure out that, hey, this guy statistically tends to lag the other guy, well, that is going to be very telling, and you're probably going to want to use the one that's leading, not the one that's lagging. So really using statistics to really test these sources is crucial, and I think that's kind of how we approach it at ICE, and it's something that has to be an ongoing process. Just because a source was good doesn't mean it's always good, so you kind of always want to kind of be smart about testing those sources.
Excellent. Yeah, we we have a lot of interesting conversations with clients, right, specifically around which data they should be utilizing which data is sort of more indicative, which data is more actionable. Along with the actual levels, we try to capture as much context around the quote as we possibly can, right? So things like sizes, where clients will look at a quote with a size as something that's a lot more actionable and less indicative. Around the BWIC process, capturing not just price talk, but also covers, capturing which bonds actually trade, sort of goes a long way to determining sort of that hierarchy that you guys have spoken about. Rajan, wasn't
even the tool you showed earlier about how you break it out into different tiers of the sources, that is crucially important too. Knowing kind of the size and the breadth of the market making that's happening at some of the different sources, I think is very valuable that you guys offer that to your clients.
Definitely. And so one thing that was also it was probably worth mentioning in that screenshot, right? So in some cases, you're getting 5 quotes from the same tier 1. In other cases, you're getting 5 quotes from 5 different tier 1s. So even though we anonymize the source, we do have a superscript, sort of what we call a tier designation. So you'll see like a tier 1A, tier 1B, tier 1C that tells you that there's a depth to the market, that it's not the same tier 1 that's updating their levels, that there's multiple dealers that are quoting the bond, and that gives you more confidence in the level as well.
Maybe I'd add to that too, just hearing both of you guys speak there. A lot of things sort of ring true in my world. And you mentioned, of course, like size of transaction, call it lot size, things like that. That holds true. The another administrative action from the SEC a year plus ago that really focused on odd lots, but of doing some sort of, I'll call it contemporary study, continuously or periodically to sort of, I'll say, validate the things that you've chosen. And it, to be honest with you, in that case, it was, do I apply a discount for an odd lot or not? But to be honest with you, it applies in this as well. Like what hierarchy of data do I end up using? What's more reliable? I never suggest to anybody to necessarily pull a trigger immediately just because on one day something looks a little different. It's much better if you take a period of time to study. Now, if you're in the 40 Act world, you do have to make decisions sometimes about, today, do I have a good price or not? But by and large, if you're thinking about sources of data and whether it's reliable, being able to study it over a period of time is much more valuable, and again, much more persuasive to explain to anybody, whether it be an accountant, a regulator, a board, an investor, whoever might want to really understand the process that you go through.
Yeah. Yeah, and to your point, size is super important to sort of distinguish between potentially a retail trade versus an institutional trade, which comes into play quite a bit in the muni space. If you look at MSRB data, sometimes you'll see 2 trades that are off by 10, 15 points. And when you look at the size, it becomes pretty obvious what's happening. So when, in the absence of institutional MSRB levels, I think this is especially where our data becomes key, when you could source additional observable data, even though not all of it materializes in a trade. So my next question is more around sort of diligence that's done by investors and funds. And I had an interesting conversation with one of our clients that's leveraging our tool for middle back office in a distressed fund, and specifically around. So there were 2 investors that were very kind of interested on learning what their operational structure was set up like, specifically making sure that there was a lot of independence between the front office and middle and back office all the way through the third-party administrator. So the idea that this particular fund was leveraging our tool to source the data from the front office and make it available to the middle and back office completely unfiltered, right? Not sort of letting the front office cherry pick the color that they liked. And then the second piece of that, making the same data available to their administrator, which allowed everyone to get on the same page and have all the support that they needed, was something that got those two particular investors very comfortable with the way this fund was set up. And so that was a really sort of great anecdote to hear from a client. So my question to you is, how much diligence is done by LPs in these distressed funds? How much do they dig into the fair value accounting practices for illiquid assets? And how can the funds sort of leverage the story to attract LPs?
And maybe I'll start. It's sort of interesting because you really do vary based on types of products that are out there. On one spectrum, you've got a registered product, mutual funds, business development companies, whatever it might be, all of which can hold illiquids, but they're part of sort of the public markets. And so you see, I'll probably say a lot less investor inquiry because a lot of things are already sort of published or available, and that's sort of the network or the avenue in. When you're talking about the private products, that becomes much more interesting. And I think to some extent, it depends on really two factors. One, the needs of the investor base, particularly their needs for, I'll call it fair value accounting, and what they report in their I'll say desire for accuracy there. And then also a credibility thing. Quite frankly, if they're less familiar with the instruments being traded or concerned with the liquidity, it is really, really important for them to get comfortable. It becomes, again, a credibility. Is the manager credible, or at least is what they're reporting going to be credible? So that's where process becomes extremely important. I think historically, to be honest with you, they'd ask the question and they get an answer, but there really wasn't a lot behind it to support it. I think anybody who has more information or can actually delineate more clearly probably has an advantage, particularly in an asset class which investors may be a little less familiar with.
Perfect. Pierce, I don't know if you want to add to that as well.
No, I think Rajan hit it now.
Perfect. So Pierce, what are some of the best practices that you're seeing firms apply in their month-end valuation practice?
So first, it's kind of goes without saying that the regulatory environment is putting more onus of responsibility on the firms themselves, even the boards of those firms, to make sure that they understand how their bonds are priced and the methodology, the inputs, all those types of things. They can't just kind of outsource kind of how that happens. Yes, they do pay people like ICE and other firms, vendors, to come up with prices, but they had to really understand where those prices come from. So more and more we're hearing from clients, they want to get more transparency around the pricing. Some of those things we've touched on. What are the types of sources you use? Is there a size component? Do you use trades? For that price right there, how do you calculate your bid-ask spread? Those types of transparency, ultimately it's just extra data around the price or metadata. Those are things that our clients are asking for. Further, there's a couple other things at play. Clients are absolutely looking to price their book more often. Some firms used to do just monthly. Even the folks that used to do just monthly, they're now updating those prices a week before, then 3 days before, then 2, then 1, and they're trying to get ahead of it. And they're looking at those prices not only to challenge the vendor on an outlier here or there if they think something is amiss, but just get more transparency from the vendor on those couple of bonds that maybe aren't as liquid. So those are kind of themes there. And then we're even seeing now in particular markets, people really looking for intraday prices. So at ICE, we have something called CEP. It's called Continuous Evaluated Pricing. So we are pricing not just at the end of the day for 2.7 million securities, fixed income securities globally. We're pricing them all intraday. So we're picking up the spread movement as well as the rate movement for munis, corporates, agencies, treasuries, all these different asset classes around the globe. And that's really something where, especially the front office this day and age, they don't want to be a half step behind. So now you have the front office looking at intraday prices, using them in the workflow, but also use them to communicate to their back office about maybe bonds they're looking to buy and they haven't bought. That also allows the back office to get our intraday prices a couple hours before close or 1 hour before close or whenever they want to look at it, so that their end of day workflow can be tighter and faster, especially because we're seeing a little bit of this move to 4 o'clock. More people are kind of moving to 4 o'clock now. So that's kind of tightening your window. And 40X and folks like that have a tight window to get things done. So really getting insight into those prices before that actual monthly mark is key to a lot of clients. So that's something that we're really trying to help them with the transparency and the frequency of those prices.
And one thing I'll add, and that everything that Pierce just said, that's 100% accurate. And I think part of the goal for anybody is to, I'll say, use the data that again resides within house, or that it could be captured or harnessed, and figure out how to bring that in. Historically, that was probably difficult. Some of it was because of available options. Some of it was technology. Just not able to do it in an expedient enough manner. You'd have to do it more on a more lagged basis, particularly in the 40X space, where you need to do things daily, but you'd have to do it after the fact. I think one of the key things that we're seeing folks at least consider, and we certainly saw it heavily during the pandemic, was the use of, I'll say, more dynamic thresholds for tolerances, called between days, and really, as opposed to using a stale kind of, I think 3% change is something I want to look at, or 5%, and really having some false exceptions, meaning having to dig into lots of things that changed when really the market moved, or you would have expected, based on the transactional activity, that the market would have moved such, X% up or X% down. Using or being able to build that into your daily thresholds can actually either A, reduce exceptions, or B, get actually more truer exceptions, things that you really would want to investigate. So I actually think that's forthcoming because of, again, the availability of the data and the availability of the technology to pull it in on a real-time basis. So I'm bullish on the future. Let's put it that way. I think it's in steps in the right direction to help folks with what they need to accomplish, and really getting to achieve what we're all after, which is truly a fair value that's fair for investors, particularly buying into products.
Perfect. So just quickly wanted to remind all the attendees that you could post questions in the Q&A box in the webinar. It looks like there are a couple questions that came in. So for 40X firms with rigorous valuation testing already in place, what challenges does 2A5 fair value regulation pose? Can firms validate daily or backtest fixed income fair values using separately delivered observable data, similar to what the front office sees? Rajan?
Yeah, I'll be glad to sort of attempt to tackle that. It's a big question. And for every firm, Rule 2A5 poses maybe, I'll call it, different considerations. Rule 2A5 was pushed out by the SEC and finalized last year, a really big valuation initiative geared especially for boards, but with lots of other things associated with it, to really sort of establish, I'll call it, a new expectation on how in a 40X fund values investments in good faith, anything other than an exchange traded price, essentially. So a much bigger framework. I think because there's a lot of time, we've got over a year until the rule goes into effect. The first step for most are really doing some sort of, I'll say, gap analysis, trying to identify what's in the rule versus current practices, both for interacting with the board, for valuation, for oversight, a variety of different factors. And really, actually, back to my favorite subject, but US GAAP, one thing that the Rule 2A5 does is it does not set, I'll say, accounting standards, or rescind sort of accounting standards that the Securities and Exchange Commission might have put forth before, and really points to ASC 820 as sort of what funds should do. And I think what's interesting is, though, while most people, of course, they follow GAAP, there may be certain things, I'll say, in their practice or policies that may not be sensitive to that, and sort of the desire to be able to demonstrate to a regulator that they've truly understood the concepts in ASC 820 and have really followed it closely. That's an interesting sort of nuance. I think that's a good first step that a lot of folks are encountering. There are other things that'll be challenges. There's a lot of focus on risk assessment at a more, I'll say, granular level than probably historically existed. I think many fund groups have, of course, always had a lot of very good procedures in place to monitor valuations and to make sure they're getting the best valuations they can. They probably haven't always, though, written out clearly, distinctly, so that they can monitor listing of all those valuation risks that do exist, and to be somewhat granular to the types of investments that they have. They've been probably historically more generic, haven't maybe always focused on conflicts of interest. I think that becomes probably a little bit more of a documentation exercise to be able to demonstrate the thought process and the procedures that are in line with addressing those risks. But it's always possible someone will find that there's risks that they haven't identified before, really haven't addressed, and that would be new. So I do think that's a change and maybe a little bit of a challenge, but I think that's maybe a second step. I do think sort of oversight of pricing service providers is an interesting nuance. It's sort of requirement in the standard. And while, again, groups have done that historically and have conducted much in the way of oversight, the rule itself does list several sort of considerations that fund groups should go through, including evaluating the quality of the pricing information. This gets to the heart of a lot of our discussion today, and also understanding how close that information is to the time that you're essentially striking NAV or the close of the market. So those sort of considerations, while again inherently probably considered before, maybe not as explicit. And I do think there's some work there that groups are thinking through as it relates to their oversight model. So that's really on the 40 Act side. The private side is exempt from the rule, but I think the SEC staff would likely encourage folks to consider aspects of the rule, not because you have to follow it, but really because there may be some practices in there that would be, call them good practices for private funds to consider. I know I've heard the staffs made that comment at least on one or two occasions. So I think that's a message for the private fund community, but the 40 Act community is the one that really has to adopt it.
Excellent. Excellent. Thank you for that. So this question's for peers. So when markets are sleepy, not moving quickly, it's easier to do fair value analysis. When markets are moving fast, it obviously becomes harder. What can be done to capture efficiencies and get things done by the 4 o'clock?
Yeah, so it's a good question. It's probably one of the most important questions. It is true. Markets aren't moving very much. Data from 6 hours ago, maybe the best data, might be perfectly accurate and great. When markets are moving quickly, that old data can really hurt you if you're using it, and the markets have moved since then. So with that in mind, you kind of have to back up and think about the task at hand. The task at hand is you're trying to price 2.7, 2.8 million fixed income securities globally, and you only have 5, 6, 7% of them, maybe 8% that have market data, trades, bids, offers, that kind of stuff. So you got 92% left over that you have to keep up with the liquid 8%, if you will. So that requires a big extrapolation. So at ICE, of course, we have technology and data and models, curves that we're using, all those types of things to make sure the liquid space helps inform us about the space that's not as liquid, but it can't be slow. It has to be very, very fast. So really making sure you're extrapolating on the space that has market color on the rest of it is very important. Frankly, it's one of the reasons we released our real-time pricing over 5 years ago, actually, was to kind of prove to the market we do have a very tight process. Because if you're pricing 2.8 million securities that are updating every minute or two, those prices aren't going to be good if you don't have a really tight process. That process includes absolutely a big team of evaluators that are very specialized in their different asset classes, who are leveraging the technology and the data and even the dynamic outliers, things like that were earlier mentioned, to make sure the best data is getting in and to make sure the timeliness of the data is always looked at. In a very fast market, you need those most recent observations. And frankly, you can't have the part of the market that doesn't trade very often kind of sitting and we'll get to it later or tomorrow. No way. That's really not going to produce a good product. People aren't going to want to pay you for that product. So the timeliness of that is crucially important. And I can't emphasize enough, it is really a combination, though, of people, the data, the technology, the team together, because to be able to turn those things around always still requires expertise, input. You even have situations where bonds that haven't traded in a long time, they don't get quoted in a fast moving market like March of 2020, all of a sudden they trade out of the woodwork. So if you don't pick up those trades quickly for that day they traded, your clients aren't going to be happy. So you really have to have a comprehensive process put together. So it's hard, it's very hard, but with a tight process, I think it's something that you can successfully stay on top of.
Pierce, maybe I'll add to that just a little bit, because what it strikes to me is when markets are really volatile, what you have to do is, I'll say, eliminate the tasks that really aren't that necessary. Things that you're already doing, or maybe reporting. Think about in-house reporting that somebody may want to see that you spend time doing. You just don't necessarily have time to do that. And I think really the ability to be, on the fly, to be quick, really talks about changing up some of the things that you've done historically that just, like I said, don't add any value to the process or aren't accomplishing the end goal. And I think it's really important for groups to do that. I thought the pandemic helped teach that. And I think it's sometimes easier when markets are calm just to slip back into things that are comfortable, but maybe there's some things that need to be changed in order to survive going forward.
Yeah, totally agree with that.
Excellent. Can the data be used for fund accounting? So I could take that one. So where we typically see our data used in middle and back office is, as we discussed earlier, firms are required to demonstrate independence and rigor in their valuation processes. So where we typically see our data be used in middle and back office is for validating the pricing that firms are receiving from the ICE, from somebody like an ICE, and using that to potentially challenge the price and sort of document the process. The next question has two parts, and I think it basically speaks to the fact that you guys sort of come from two sides of the business, right? There's the audit side and there's the valuation side. So the first part is for Rajan, the second is for Pierce. For Rajan, if you have varying evaluated prices for a security, how do you choose which evaluated firm is pricing it best? And then the flip side for Pierce is, if you have varying dealer quotes that are far apart, how do you determine which is the best?
Yeah, I mean, obviously it's judgmental 100%, but it's usually go back to the same sort of principles of doing some sort of, I'll say, study, looking at the evaluated prices compared against, I'll say, transactional data that might be available, particularly starting with your own trades, talking with your own trading group on, what they're seeing and hearing, and then trying to evaluate whether or not one of the sources is better. Same sort of argument one might do in deciding whether to use a bid price, or mid pricing, because it's the same sort of like what are we actually trading at? So I think that's fundamental to helping to make a determination of which source might be most appropriate for a particular security or asset class.
And to second that, right? So this is exactly how our data is being used in the middle and back office, right? Because firms often source multiple prices from the evaluated pricing services, and when markets are calm, those are typically pretty much in line, but oftentimes they could be 5-10 points apart or more. And this is exactly where market color and observable data is key, where you could go back to the evaluated pricing service and potentially point out something that they haven't seen, or make a determination that for this particular security, Pierce has potentially access to data that other people are not seeing, so we're going to go with this level. Pierce, your side of the question is, what do you do when dealer quotes are far apart?
Yeah, so part of it is what was mentioned earlier about the study. So having a rigorous process whereby you're back testing the different sources. So you're knowing who's more accurate, and you can even do that by a sub-asset class level. So Just because XYZ firm is no good at this asset class, they could be fantastic at the other asset class. So doing those types of studies is the first and foremost, most obvious way of forming them. And those studies are versus trades to see how kind of close to our executions. And then the other part of it is really understanding the sources is an important piece. And then it does come back to people as well. The evaluators, in particular in a fast market, if you show them two bids, that evaluator, and they're very different, right? And they're both very different than where the price was from the evaluation. So something's moved. And the question is kind of how much has it moved? It's actually a good evaluator can very quickly assess by looking at other data points in the market on other bonds of the same issuer or other issuers that are comparable. They can very quickly assess, oh, wait, this one is an outlier. This is a bad data point because they overshot, or it's too low, it's too high, whatever it is. They can do that kind of on the fly. And again, you don't want an evaluator to be looking at those situations all of the time because they'll be inundated with it. There's so much market data. That's again where it is coupled with a technology solution that has dynamic outliers that really provides, it really asks the question of the evaluator, the expert, when it's really tough to decide from a technology and data standpoint. In other words, give me the answers that I really need a person to kind of get involved to better understand what should be thrown out as an outlier, what shouldn't. So it does come down to process, but I think you can use your studies and statistics. You can also use the experts. And I do believe a marriage of both those two things is what provides you to consistently present, very good evaluated prices in fixed income.
Perfect. And to bolster that point, when in the early part of the presentation, when I spoke about sort of the five pieces of the puzzle, the critical workflow tools, some of the tools that are available in our product that go side by side with the data is exactly around what you just mentioned, right? So it's the ability to identify comparable securities. It's looking up and down the capital structure when there may not be a whole lot of information available, potentially identifying another security that's pari passu, or if you're trying to identify color on a 144A security, seeing that there's color and potentially the Reg S, looking at other deals of the same issuer, other deals in the same industry, and so on. So there's a good amount of screening and filtering that's available when there's not a lot of information that exists on the security that you care about. Excellent. I think we're just about out of time. I'd like to thank Rajan and Piers for participating and sharing your insights.
Thanks for having me.
John, you could close it out.
Sure. So thank you all for your participation in today's discussion, especially to our panelists. We hope the attendees have found it fruitful. Be on the lookout for a recorded version of this, which will be sent to all registrants via email after we conclude here. If you have additional questions or comments, and there were a couple questions we didn't get to that we'll send follow-ups to, but if you have any additional questions, you can email them to info@solveadvisors.com. Otherwise, thank you all for joining, and everyone have a great day.
Thanks.
Oh, thank you.